Hello and welcome to this week's instalment of Nucleus Investment Insights. Well, as the peak isolation period begins to draw to an end and the economy begins to find its feet after this unprecedented epidemic event, attention is now focused on how the severe demand disruption will wash through company earnings and subsequently stock prices. But hang on. The S&P 500 is currently up 40% on March lows, the Nasdaq has never been higher, and locally the ASX 200 is sitting at levels last seen when underemployment was nearly half what it is now. So what gives? Here to discuss what comes next when markets disconnect from reality, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello, Damien.
Hi, Tim. How you going?
And back in the webinar saddle after some time, we also have our Chief Strategist, David Llewellyn-Smith. G'day, David.
G'day, Tim.
Wonderful. And just a quick reminder before we get started to subscribe on YouTube and click on the notification bell to be notified of when we go live or have a new webinar to watch. Or follow us on your preferred podcast platform. And for those listening in live now, feel free to drop in your questions in the chat box at nucleuswealth.com/webinar to have them answered along the way. So we'll kick off with our agenda today. So we'll quickly run through, we'll have a focus on why the market has risen. We'll then be looking at the current economic conditions, asking the question of are we in the new normal, and then running through some of the key areas that we are most concerned about. And then, of course, wrapping it up and taking any questions and finishing off with those investment implications as well. So I'll hand over to our Head of Investments, Damien Klassen, to kick off why the market has risen. Damien.
Tim? Yeah, look, I think I'll set the agenda here quickly. There's a few different factors we've focused on in terms of looking at the market. And I think that the key thing, I guess the key message we're trying to put across is that I think investors are getting a second chance to sell. It doesn't happen very often where you have sort of major events where markets move in the direction and then retrace all of that direction and actually give you a second shot, whether it's buying or selling, second shot at what comes next. So I think what we're trying to push through in terms of this is what are the factors that are leading us to these conclusions, and where are we seeing sort of that real dislocation between what's happening in markets and what's happening in economies. So we'll start with the why. I've got the upper chart just sort of showing central bank printing. So quantitative easing. This one's just showing over the last sort of 12 odd years the month-to-month rise in quantitative easing, and so I guess the key point there is there's a lot more being spent in terms of quantitative easing now than what we've ever seen before. And the question is, is some of that ending up back in the stock market? And I guess that's certainly Fed's intention to get people to sort of lower risk assets and actually into making investments and getting out and pushing it, getting out and getting the economy started again. The thing is, isn't the type of ideally what they want is they want actually companies, they want to down the price of bonds, get people to invest in companies, and then those companies go out and actually make investments and go to hire people and hire new staff and build new factories and actually the economy sort of ticking over again. That's not what's happening at the moment. Is that money is basically being stopping in the stock market, and it's being used to either pay down debt or it's being used to bid up stock prices. So we haven't got to the stage yet where companies are actually saying, let's get out and spend this money and let's start a new project and let's take advantage of these low interest rates. That's some way away, and especially as most companies are facing they've got an excess amount of manufacturing capability or service capability. They're actually letting go of staff because they've got too many people on at the moment. So that sort of leaves no real release valve for that money. David, I'm not sure if you want to chip in with anything on the QE side.
No, I guess the main point to take out of it is that it gives you a high equity risk premium. So, the argument is that interest rates are so low in other interest-bearing securities that the return on stocks or the value of stocks should be higher. And some people buy that argument, others don't. It certainly seems to have worked out in the US context. and though it didn't in Japan when it was going through similar phenomena. But for the time being, at least, people believe in that, and that's sort of the kernel of truth, if you like, at the heart of this big bounce and trade, and Federal Reserve support. The question is, how much valuation support does that really provide, and how much of it is just a notion now that's turned into a crazy bid narrative that you could basically describe as a bubble.
And the other thing with that question is, any valuation depends pretty much on two things. How high that discount rate is, and then how fast it's growing. So it can become a circular argument in terms of saying, well, I've left my growth rate the same as what it is, but I've lowered my discount rate, and therefore my valuation's higher. Saying, well, the only reason you've lowered your discount rate is because growth is not going to be as good. So you get the whole part about it.
Exactly. Yes. So I mean, at this point, I think that the bid and valuations have far outstripped any kind of rationale of that kind. But I guess my takeout from quantitative easing and the various and the various monetary supports is that there is this kernel of truth to the argument, but it's nowhere near as powerful as markets would like it to be.
That sort of leads us on to this next one, which is the momentum traders, robots, and retail traders. I'll start at the end there. I've got a graph up here from Deutsche, just showing the number of accounts holding mega cap growth stocks. So these are retail accounts, and you can see that the number of retail accounts has shot up from 150,000-ish for most of last year, and closer to 100,000 the year before that, to now 250. I've sort of seen a significant increase in terms of the number, not quite doubling. Well, over 2 years, you've more than doubled. But versus last year, there's been this incredible increase in the number of retail accounts. The question is, where's that money going? And it looks like the money's heading up in some of these mega cap growth stocks. So, I guess you can come up with a whole bunch of rationales for this. I think a lot of it is people at home who are and we'll move on to
twiddling their thumbs.
Yeah, they haven't got they can't bet on sports anymore because it's all closed up, and there's only so much online gaming you can do in terms of blackjack and stuff like that, I suppose, before you feel as if you need to spread your wings and try something else. And there is a narrative going around, that this was a massive fall in the market, and this is your one chance to get set, and all that type of factor. So that's your retail trader side.
And Damien, we were just I think we were mentioning this morning, but there was a recent ASIC report just locally as well, where there was there's just been this significant blossom in new investors signing up to online brokers in Australia as well through the whole crash period, through late February into early April, around about 5,000 new accounts per day. Jumping in and obviously providing some potential retail buying pressure as well.
Yeah, that's right.
There's also a huge jump in yesterday's Westpac consumer sentiment survey in the wisest place for savings being the stock market, which is first time it's really jumped since pre-GFC, and it hasn't kind of popped like this since the dot-com bubble. So again, there's a strong kind of retail component to this. Certainly, it's not everything. It's risen way too far and fast for it to only be retail, but definitely a component of it.
Yeah. The next one, we're going to split this momentum traders and robots into two, but there's quite similar overlaps. Now, momentum traders, and there's a lot of them out there. They're running sort of quantitative methods where basically you can quantitatively work out whether stocks are going up, and basically the idea is if stocks are going up, you go out and buy them, and they'll go up even further, and then eventually they turn, and you lose a bit of money at the turn, but you have to try and get out faster than everyone else, and then you start shorting stocks on the way down, and so there's a number who explicitly follow those strategies through quantitative methods. There's a whole bunch of other accounts who effectively do it. A lot of it's through sort of technical analysis and things like that, especially some of those retailer analysis. In effect, it's the same factor. If I can draw two lines on a chart that make look like it's going up, then I assume that's going to keep going up forever. Then and or for a period of time, then that's effectively a momentum trade. And what seems to be happening anyway from our point of view is that those moves are getting faster, and they're getting as they're getting more automation in terms of these, and they're getting bigger in terms of as interest rates have fallen. It means people can get a bit more leverage within these trades, and you are finding that these moves are happening quite quickly. We've sort of had one of the fastest falls ever, and then one of the fastest rises ever, and it's sort of showing that these momentum type trades really get behind things. They just push things to the extreme in both directions. So it's certainly one thing to be considering, that the movements are probably going to be happening a lot faster than what we've seen in the past.
I think that's fair enough. It's probably a lesson to come out of the last 3 months. As Nomura described it, these days you can actually get a crash up as well as a crash down, which we've certainly seen very large bear market rallies in the past, but it does look like the amplitude of stuff is more extreme, and that may well explain why. The second component to that robots stuff as well is, the crash in March was really largely driven by the risk parity traders, which is these automated sort of system traders that dynamically or tactically dynamically shift between stocks and bonds and balance between the two, leveraging here and there depending on where they see themselves in the cycle.
And also, but a lot of that's mechanical in terms of the volatility. If there's lots of volatility, then they have to sell stuff, and if there's no volatility, then they buy lots of stuff.
Absolutely. But I guess what struck me over the last 3 months is we've basically seen a full financial cycle that would generally take 3 years in 3 months. And this is
and so when you say financial cycle, you mean stock market financial cycle, like as if
stock and credit cycle, basically.
Yeah, what they would do during a usual economic cycle.
Yes, that's right. And it's not like nothing has happened in the sequence of events that wouldn't normally happen, but it's happened lightning fast in this bizarre way, where it's completely decoupled from the underlying economy. And so I was sort of theorizing that what we've got, in a way, is this strange kind of algo fantasy going on in markets, where they're proceeding through an entire kind of financial cycle whilst they exist in this strange kind of nether world, with the real economy just dead underneath it. And so it's like, I've called this fakeflation or fantasyflation, where you have a full kind of financial credit equity cycle going on on steroids, while underlying that there's actually nothing going on at all in the economy. And so if you just focus on the various rotations that we've been through in the last 3 months, it was, we had a boom coming into the new year, followed by
Sorry, Tim, can you just flick to the next slide?
Yeah, sure.
Sorry, Dave.
Yep. That's all right. And we had this boom coming into the new year as the virus spread, and there was a little bit of stimulus behind that, followed by the sudden realization that it was all going to go pear-shaped, and the crash. We had the usual US dollar safe haven trade and huge bond bid, flight to quality in stocks, as everything fell apart. And then the Fed steps in with its big stimulus, as well as other central banks, bounce off the lows for stocks. Then the big momentum trade kicked in, and then it started to accelerate through all of this until suddenly the US, a few weeks ago, maybe a month ago, the US dollar safe haven trade starts to unwind. You get the big emerging market bid. Money starts to flow back into commodities. Bonds start to sell. And then in the last few weeks, we've started to have a bond backup and a rotation into value stocks. Now, that cycle happens basically every business cycle. But it doesn't happen this fast.
And more importantly, it happens because that's what it's sort of following the economy.
Exactly. It's following the economy. And So what we're kind of postulating here is that you've got this any strategist knows that this is the way the cycle transpires, and so you can write this into an algo and a robot, and it's as if a whole bunch of robots have competed to get through this cycle first, but dislocated completely from the underlying economy.
Yeah. And so what David means there in terms of those is that, let's say you're looking at this momentum trade and then the bond starts selling, is if you've written the program, you're basically saying, okay, well, I need to be watching for when the momentum trade kicks in, and then I need to trade that up, and then once that's had a bit of a run, then I need to start selling off my bonds and my US dollar. So whereas the program says, okay, that's going to take a year to come about, is that I need to be on the ball, because if the bonds do start to sell and then the US dollar safe haven starts to unwind, then I need to jump in first and make sure that I don't miss the trade. There's no sort of patience in it. So those models are all sitting there doing is going, I'm waiting for the next sign. The next sign's here already. I was expecting that to take a year. It only took a week.
Took a week. That's right. And I mean the thing is, it's like with the Fed channeling heaps of free money, there's a lot of stimulus to kind of flow through it. And then you've got fiscal underpinning it as well. It's giving you like somewhat lift in kind of market sentiment to drive it a bit as well. And meanwhile, the real economy has just been completely forgotten by this cycle. And perhaps that's because it's an unprecedented event in the virus. I mean, you could possibly argue that the virus and a V-shaped recovery should be this accelerated, because that's the way a virus shock might work. But if you look at the real economies and the way that the virus is transpiring, the pandemic itself is transpiring with reference to reopening of economies, it makes no sense whatsoever. Like if anything, the virus is going to delay recoveries, slow down this cycle, make recovery much more difficult, keep earnings lower for longer. But none of those things can register in this cycle if it's a kind of algo fantasy. And so, that's the theory anyway, that this is kind of what's underpinned it. And then you tip in the other things we've discussed with the retail frenzy and momentum, and bada bing, bada bang, you've just got this runaway bid that is now at insane levels, even if things were good. But through how we see the global economy transpiring, it's Twilight Zone stuff.
Mm.
And certainly this last, I'd say, until maybe the second last week of May, you sort of look at the moves in the markets, and while they were certainly bigger than the bounce you would have expected, you could sort of, the sectors that were performing were like, you'd sort of go, okay, well, these are the ones that are least affected by the virus, and so therefore I can understand why, at least if the market's going to move up, these are the sectors that are going to lead. That last week of May and the first couple of weeks of June sort of flipped on its head, and now it's been this rotation into some value stocks where they tend to be the cyclical stocks, where it's sort of basically saying, oh, well, the economy's about to go into a cyclical boom, and so therefore I need to be out buying banks, and I need to be out buying some of these the stocks that were hit the hardest in terms of your travel stocks or your airlines and all these other ones. They're sort of saying, well, earnings are still down 20% and sometimes 100% in some of these sectors.
Well,
yes, there will be time for them, but I'd like to actually see some recovery first.
Yeah, I mean, you're exactly right on that last one. I think that last rotation is a bit of a giveaway, and this is what was interesting about last night with the Fed. The Fed was very dovish last night, but it actually caused a sell-off in the market because it disrupted that fantasy of recovery by saying interest rates would have to stay low, right? It basically said interest rates are going to stay low forever. And so the bond backup reversed, which is the recovery play in the algo fantasy, and all of the rotation into value now is crashed today, because the Fed is, even though the Fed has said it's going to be a great recovery, but interest rates will be low forever, that simple taste of reality has completely reversed, the tail end of this fantasyflation. So we'll see how much further it can run. But I think you're exactly right in that last one's just a very good example of how strange this is.
Fellas, I've got a question, a couple of questions come in, one relevant to now, I think. If algos are running the market, when will the real money make a difference again?
I think we've got we possibly even title a slide that. Let's
Okay.
that one we'll leave off for a little bit.
Okay. And just a quick question of mine, actually, probably to Damien, or you've been following what's been happening from a market level perspective, but is it a volume thing? So is it low volumes on either side that are pushing? I.e., maybe just leading back to the question of when the real money rolls back in again. Is that?
No, not particularly.
No. Okay. Yeah. So
I think it's more in terms of saying you can have the leverage behind these. I guess there's two parts. One is there's a lot of momentum traders out there now, and they're all, a lot of them are more automated. So I think
you should note that if by real money you mean volume of money, and there is volume of money in these trades.
Yep.
In this approach. So I mean there is real volume of money. That said, I think most of the humans in the market are still very bearish.
Yep.
So there's an awful lot of money on the sidelines still.
Okay. But the momentum trades are very much that. They're very big, and what we're saying is very fast. And once you start seeing a trade in place, you start getting all these people piled in, and it's a bit self fulfilling.
Yep.
And we saw, like, pre the financial crisis, there was it was a little bit that way, and there was a lot of quantitative strategies out there. They were slightly different, but a lot of it was the same, and a lot of those blew up. They sort of called it the quant quake in 2008, where there was just so many people following the same strategies, and so the strategies worked really well because you've got so many people following them. And they sort of everyone following the same strategy, and the strategy works well, and it doesn't. And then all of a sudden, all these guys lost bucket loads of money all in a very short period of time, and they actually all started shutting down those funds. There was sort of a 10-year period where we just didn't have a lot of those funds because people had been scared away from it. So it looks as if there's something similar going on. But, anyway, so that's one side of it. The next part, I just want to talk quickly about inequality as well. Got a couple of graphs up there about this. You can cut this a number of different ways. I had one up on something I posted a week or two ago about the showing the wages and how most of the unemployment that you'd seen came from people who were in low wages. So, and as you sort of think through that process, it's like, well, if you're a white collar worker, much more likely to be able to work from home. So keep your job than if you're a blue collar worker and often doing manual labor where you just couldn't get out and do whatever it was you're meant to be doing. So there's that side of it in terms of inequality. There's another one here from the Wall Street Journal, which is just showing the consumer confidence for over 65s. So has taken a rapid bounce back. So as markets, it tanked as the whole coronavirus thing started. As the markets bounce back, I mean, it's still very low. Don't sort of stake too much into it. But I guess if you're over 65 and you've got a decent investment portfolio and your investment portfolio has bounced back, then you're feeling a fair bit better about yourself than you did a few weeks ago. Or if you're in the 18 to 35 group where you probably don't have a large investment portfolio, then you're not feeling good about yourself. That's actually getting worse in terms of the confidence within that. So that's this part where basically what it's saying within these is that if there's might be less money out there, but if it's largely distributed in people who are quite rich, then that's more likely that's going to end up in the market.
Yep.
Than if you but by the same token, it actually means the economic shock is going to be just as bad because the poorer people who create a lot of demand for all these products and are the ones you actually need to be getting out there and buying, they're not doing well, and they're bearing the brunt in terms of the economic damage. So you've got both the younger people and poorer people, bearing that brunt. Well, they're the ones who are most likely to spend money and consume and actually make profits for these companies. So it's this weird disconnect again, in that you've got the market bid up because richer people have got to do something with their money and they can't get out and spend it at the moment, but the people creating the demand just aren't doing it, and so there's this disconnect again in terms of valuations.
Okay.
Right, and the final one I had was your charts, Tim. When you flick through, just sort of showing this issue about mistaking direction for a position. And so what what it's showing here is the number of jobs and sort of cumulative jobs on the left, where it's sort of you're seeing these 20 it's US stats.
US stats, yep.
It's showing 20-something million jobs sort of over a 10-year period, and then all those jobs get lost in 1 month. But then in May there's this bounce back. That's on the left-hand side. So it still looks like a pretty dire graph, and the bounce back looks like it's certainly come off its bottom, but it's nowhere near what's been lost. Whereas the one on the right, you could argue that sort of says, oh, we had a one-off blip, and now we're actually going ahead. So there's 2.5 million people added last month, and so therefore markets should be going up because payrolls come back and off you go. So I guess it's this point about saying there's going to be a lot of statistics coming out now that are going to look very, very good, not because they are very good, but because the market's fallen 90%, for example, and then it doubles. So you've gone from 100 down to 10. You've gone from 10 to 20, and you're like, oh, the market's doubled in the last month. And you're like, yeah, well, it's down 80% still. So it's those factors where there's a bit of that in terms of market basically saying, well, most of the news that's coming out is good news in terms of it's the sign on these numbers are positive because they were so negative for that 1 or 2 months that now the signs almost have to be positive because there's just no much further these things can fall. So again, it's only it's if you said to me markets had fallen 50-60%, and then we had this surprise for payroll up 2.5 million, I'd say, okay, well, there's a reason for markets to fall because they've priced in an appropriate drop, and now things have gone positive, and so then they can start building up on that. But when markets are basically back to pretty much where they started from, I'd then say, oh well, this extra employment is fantastic. You can't sort of taking the you need to know where you are, not just the actual movements within the markets.
Good point.
So let's use that to where actually are we? And so I might leave across to Dave for a quick discussion about current global economic conditions.
Yeah, so conveniently the OECD put out its 6 monthly forecasts last night, and they offer us a pretty convenient way of having a look at this, and they do use the aggregated chart rather than the rate of change stuff. So we've got a chart here showing it's 2 scenarios for recovery, and one of them is where the virus doesn't get worse again, so there's no second wave, as it were, and one of them is a second wave scenario. But in both of them, you can see that you get what can be described as a V-shaped recovery, sort of, but it's very swoosh-shaped, and even 2 years out, you're still materially below the economic output of 2019, and that's in the better case scenario. In the worst case, you are looking at probably 5 or 6 years before you even get back to 2019 output, and the obvious implication for that for assets is that earnings will be crushed for some years. And so when you're looking at these market valuations that are anticipating, snapback growth and similar swift rebounds in corporate earnings, then that just doesn't fit. So, I mean, our base case, or my base case, is actually somewhere in between these 2 scenarios. I don't think we're going to see, barring a mutation and a second wave of the virus, of a new strain of the virus. I think we're more stuck on kind of almost like an eternal dance with this thing, rather than a second wave. There are varying severities of that in different economies. Obviously, Australia and New Zealand have done exceptionally well. China's done pretty well too. Europe's doing okay, whereas the US is terrible, and emerging markets are disastrous. And so what that means for global growth is you're going to have this kind of half lockdown running almost in perpetuity that will deliver, a kind of slow infection rate for the virus, with, material damage to growth, but no herd immunity for years and years and years. And so it's a kind of a worst case scenario where you can either cure it, rid of it, or you can't stop the lockdowns either. And this is very obviously what's transpiring in the US, where some states have locked down and others haven't. You have got what you could call a second wave already underway there. Really, it's just the first wave ongoing. And it's like a public pool. Unless everybody commits to not being in one corner, then everyone gets pissed on. It's just a simple case that you go all in with a lockdown or you don't go in at all. And if you end up in this scenario of half lockdowns, then you're just kind of, damaging economic output almost, inexhaustibly. And so, the base case scenario for global recovery is this slow swoosh, and the implications for earnings is pretty dire. I mean, as Damo said in the previous chart, if you look at it in terms of direction, then it can well look V-shaped. But in this scenario that we're outlining here, we can get 18 months into recovery here and still effectively be in a 5% recession for global growth from where we started. So running into hugely high valuations for stocks, which very much depend on nominal growth for earnings growth, just makes no sense. It doesn't add up.
Yeah,
Either you've got to recover much faster, you've got to get a vaccine or a cure, or stocks have to remain at nosebleed levels over an enormous gulf. It's not just looking over the gap; it's looking over the Grand Canyon.
And I guess that's just part about you saying, is it possible that stock markets could ignore earnings for 5 years until profit recovers? You go, well, I guess it is, but it seems highly unlikely. The stock market's never done that before. I mean, there's this argument, and you see it from the perma bulls that the stock markets will eventually recover. Is sort of like this favorite argument that comes out all the time, and you're absolutely right. They will eventually recover, but the ASX 200 tapped out at 7,000 in 2007, or just below 7,000 in 2007. So we're 13 years later and we're still below in Australia. So if you buy in at the wrong time, I mean that's ignoring dividends, but X that, if you buy in at the wrong time, 13 years is a pretty long time for prices to sort of go nowhere. You could use that argument to say, well, stocks should never ever fall because eventually they'll recover, and so they should never go down at all. And so you should always pay more for it. And so whereas that's obviously not what we're espousing as our economic theory.
I mean, another opposite example of that is, obviously with the NASDAQ going nuts, you could have bought Cisco in 2000 and you're still waiting to recover. It's a great company with terrific earnings, but you've got nowhere near back to where it was.
Yeah, just because you paid way too much for it. So earnings have grown, but the stock price is backwards.
Yeah.
So that sort of, I guess there's three types. Sort of, if you're saying, well, let's say we were in a new normal, and you sort of took the view that and central banks and governments bail everyone out, because I guess that's your major argument is against what we're saying. Is that look, central bank liquidity is going to overwhelm any insolvency risks, and any government stimulus is just going to overwhelm any economic damage that's done. It's not a particularly subtle argument. In the end, it's basically just saying central banks are going to buy everything or fund everything, and eventually they'll start buying equities. Is what you'll see from people as an argument. But when you sort of dig a little bit deeper into that argument, it sort of becomes a bit less convincing. So I guess the way we're looking at it is you've really got two choices in terms of the economic damage that's going to be done. You can either take some pain. You don't want to take too much pain, obviously, up front. You want to limit the pain and limit the unemployment, but you can also go too far and you can delay too much, and you end up with this really long, drawn-out recovery. And probably Japan's a good example of that, where you just end up with zombie companies and all this too much debt, and the recovery just takes 20-something years as you're stuck in this low-growth scenario. it does seem as if, at the moment anyway, governments and central banks are looking for that second option. They're basically saying, yes, if there's any chance to delay the pain, then that's what we'll go for. And so we've sort of put down, 3 different scenarios or 3 different places where this will play out, and some of them they'll be successful, and other ones they won't. So the first one is these large companies. So can central banks and governments bail out large companies? Now the answer is yes, they absolutely can, and most probably will. You do have these questions about how long they can keep going, sort of, but putting money into companies that are probably insolvent otherwise, and can the Fed keep buying corporate debt? There's question marks about whether it's allowed to buy it in the first place, but those aside, how much?
Well, there's also the question: will it actually buy anything? I mean, there are parts of the market where it hasn't even had to buy anything. It's simply the prospect of them buying has triggered the flows back in anyway. So
yeah, absolutely. What that means for that part is we just expect there will be these zombie companies that have just got such enormous debt burdens because they've had to build up this. They've had these big losses. They've already started with a high level of debt. They've had some big losses during the coronavirus, and now they've got to face lower profits than what they would have otherwise had, which just leaves them in this point of never being able to pay off that debt, and means the recovery everything just drags out, and you end up with these zombie companies just slowing your economy down, rather than sort of taking what the US is usually pretty good at is companies go broke. The debt holders become equity holders. The equity holders lose their money, and off goes the company again. With another shot. But so we sort of figure that yes, central banks and governments probably will be stuff in large companies. Where it starts to fall down though is where you start looking at small and medium companies. Now these ones make up about actually 50 to 70% of most economies, and the issue with them is they don't have the listed debt that central banks can buy. So if a government's saying we want to bail out all these small businesses, well the question we still don't have an answer to is how. We saw the Australian government say, okay, small businesses are going to fall over. We're going to help them get extra access to debt. So we're going to give $40 billion worth of extra debt for these companies, delivered via the banks, so that we don't have to worry about fraud and things like that. Now it looks like the banks are probably on target to do about 10% of that. Mm-hmm. So 90%. We thought the numbers were off on JobKeeper. 50% of the rate, but it's probably going to be more like 10% in terms of the in terms of this. It is hard to prop up a small business. The number and it doesn't take a lot of it doesn't take a lot to actually, as a small business person, to work out how to defraud governments and things like that. You take a loan, you transfer the assets into your wife's name, you pay your brother-in-law to do your fit out and whatever it is, and then you declare bankruptcy. So it's go, money's all gone. Sorry, I spent it all on all this other stuff. So and play that by a couple of million small businesses. There's obviously there's too much. It's too much trouble for governments to wade into that area, and the fraud risks are too high that they generally don't. And so we still haven't seen any economy anywhere around the world that's come up with a reason that we'd actually look at and say, here we can see how they're going to bail out that area of the market. And so if that area is not bailed out, then we are still going to keep seeing those job losses. And then you say, well, can central banks and governments keep paying unemployment benefits to people that are well above old unemployment benefits? And you say, yeah, absolutely they can. They can keep printing money and doing that. But again, it's a question about how long can you do it for? Most globally, most of those plans were sort of front loaded. Australia's is probably one of the longer ones, running at about 6 months. But there's this question about saying, let's say we haven't got a cure, and at the moment we don't, and so we're going to have a different economy where there's going to be old jobs that just aren't there anymore, and people are going to need to find different jobs and different things to be productive. Is that as a government, they want to actually get out there and help people find these new jobs and encourage them. And if you're paying people $1,500 a fortnight to stay home, there's going to be a decent amount of people who will say, well, you know what, actually I don't need to find a new job. I'm quite happy on this money and not having to do anything. And so there's this push-pull between how do I get people back out? I can't keep paying them this amount forever, because then there are people out there who will take the money forever. And so, that whole push-pull about how long will governments be prepared to pay elevated unemployment benefits for? Will it be years? I don't know, possibly. But again, I think that's going to delay a recovery as well. Like the longer you've got people on that elevated rates.
There is the alternative scenario that, the patchwork of bailouts and supports and stimulus that we've seen for the unemployed, and whether that be temporary or longer term, could sort of merge and morph into something more like a modern monetary theory approach, which would be to print money for government bonds that, in effect, provide some sort of ongoing income.
MMT, I don't think there's not even government bonds there. You just print the money and give it.
Or print the money and give it, either way. And so universal basic incomes, those kind of things. But I mean, despite the virus triggering an MMT style approach to stimulus, I guess, much more widely than we've ever seen before, the conversation hasn't really taken that in as anything other than temporary. And it's still a big intellectual leap, I think, and cultural leap, for that matter, systemic leap, to get to where the governments would start looking at making it permanent. I mean, I think you might have seen something like that in the US if Bernie had gotten the nomination in the presidential election. But it's going to take that kind of paradigm shift in politics, I think, to get us there. So I don't really see that kind of transpiring as the alternative scenario yet.
And look, David, that also leads to this whole point. Look, I don't want to downplay the Black Lives Matters protests, because they are very important, and it's an extremely important issue. If you were a member of the 0.1% in the US, and and all this inequality had been getting worse and worse and worse, and you're worried, are people going to rise up, and you're going to see more of this Wall Street, 1% type problems that we had last time there was a crisis, and next thing you know, you do end up in a problem where all of a sudden there's much higher tax rates, and the economy is all about how do we redistribute and get some inequality, so get some equality back into the system. Is that, in a way, the Black Lives Matters has taken a lot of that oxygen out of or it's given an outlet for people who want to protest about it and want to complain about things. And here you go, here's an outlet. You can complain about this, and then you don't have to complain about the inequality part. We'll keep making the inequality get worse while everyone can complain about this, and then we'll put in some measures for that, and then you can feel happy you've achieved something at actually solving some of the problems, some of the base problems.
Oh well, let's not get onto the fake left.
Yes.
I'll start tearing my hair out.
And having said that, he doesn't like the fake right either. So, or the real right.
Absolutely.
We're centrists here. Yes.
Yes.
For anyone who wants to write in and complain. That last part, though, that last point I had there on this, are we in the new normal? This last point is going, well, if central banks and governments are going, if you're buying the market because central banks, you've just got the view that, look, central banks and governments are going to do whatever it takes, whenever it takes. They're going to bail it out. I don't know how they're going to bail out small and medium businesses, but they will. I don't know how they're going to solve the demand, but they will. If you have this sort of view, then you basically almost, the logical step is saying, I think it's the end of capitalism. I don't think companies are going to be allowed to go broke, and I don't think unemployed people will need to find new jobs because we'll just keep paying them, and it's going to keep throwing more money at the solution. And it's effectively the suspension of capitalism, and therefore my solution to the suspension of capitalism, I should go out and buy stocks. Sounds like not really where you should end up if that was your premise.
Yeah. Well, it'll certainly be a peculiar kind of suspension of capitalism.
Yes. So that brings back to what's going to bring market back to reality. And so that's on this next slide. Look, the true answer from us is we don't know. I've got a bunch of things crossed out here. You could say, well, Q1 earnings and companies coming through and talking about how much they're going to lose in terms of profits. A lot of very big, very stable companies are down 50% in terms of profitability. Enough. You could say, if you're sitting a few months ago, you go, well, if it was clear that the US wasn't in control of the virus, maybe that would be enough to spark markets to some reality. Well, that's happened, and that clearly hasn't been enough to spark reality in the markets. Rampant virus throughout developing countries, devastating, these just completely out of control in places like Brazil and India. That's happened. That hasn't been enough. This intensification of the US-Chinese trade war, the thing market got so worried about over the last 2 or 3 years is back. That hasn't bothered markets. Kept going to new highs. Widespread rioting in the US. Used to say, would that bring? And so as we're crossing off, in the end, for us, it looks like the most likely scenario is earnings not bouncing back. And so, but at what stage does that become reality? And it's hard to tell. We have the next set of quarterly results out, starting at about a little over a month. They'll start. They won't really get into full swing until about 2 months. So, is that going to be enough?
So when you
that's still going to be in the revision mirror, isn't it, for Q2? And it's still probably close enough to the virus to say, well, that's not part of the V-shaped recovery.
3 months after that?
The outlooks might, companies have suspended guidance, obviously, and that will have to start filtering back in, and so that could create some waves during the forthcoming profit season. But then I do wonder if the Q3 profit season will be really the crunch, which obviously is not until September? Is it?
No, October, November.
November. Yeah. So at that point, if you still don't have a trajectory of earnings recovery, then obviously you sort of headed back very quickly towards where we were in 2019 to justify the valuations. Then you're going to have a very serious problem.
Yeah, and it keeps creeping out as well. So it sort of goes, oh well, don't worry about Q1 because that's just going to be a virus quarter, and Q2 will be a little bit down, but Q3 everything should be fine. Now that's obviously being pushed out to Q1 and Q2 are no good, but Q3 that's still the virus. So look at Q4 and beyond, and then it'll be long for 2020 and 2021 and 2022 numbers.
And do you think that'll be the time when, like the typical despair period of these sort of corrections sort of kicks in, when it has been, when the memory is just all of falling earnings and depressed earnings and falling revenues? And you
can't say that at this point.
No, but I'm saying like Q4 perhaps.
We have euphoria. We don't have despair.
Well, we had despair for like a week or maybe at least a few days back a month or so ago. We've been through that stage. Yeah. So, we start looking at companies and going, well, yes, it's fine. I'll pay 100 times earnings for this because I think it'll be back to 20 times. Once it's earnings recover 80%. So it's earnings have fallen from 100 down to 20, but I assume it's going to go back to 100 in 3 or 4 years' time. So, look, it's hard to know what the catalyst is going to be. Maybe it'll be companies going broke, but maybe then again, see central banks stepping in and trying to make sure companies don't go broke.
The other possibility, and we got a hint of this last night, I think, from the Fed. I think for this whole fantasy inflation to continue, the Fed needs to continue to go deeper. Like I don't think it's enough for it to sit on its hands now. It goes back to this sort of notion that there's a kernel of truth here in the suspension of capitalism, but that suspension has to keep getting deeper and broader for it to support these kind of valuations the further into poor earnings you get. And so one of the reasons we're seeing the sell-off after the Fed, I think, is it's still only mulling yield curve control, which is something that the RBA is already doing, like keeping the long end of the bond curve flat, which is kind of the next step in its control of capitalism. Then beyond that, the market clearly wants it to go into negative interest rates, and the obvious implication for that is that it would support higher equity valuations again. And then there's, buying equities directly. But, to get through each one of these stages of further nationalisation of the markets, the market's going to have to tell the Fed to do it, and the only way it can do that is to actually start to reflect reality. So the Fed will be required to suspend reality over and over again to support the fantasyflation.
Yeah. We've got a comment up there from IG 316534, which is suggesting that Trump losing in November could be the other thing that is the market back to reality. And if Joe Biden is through he's going to raise corporate taxes by, how much was it again, David? I can't remember what it was.
I think it's to 28%. It's material.
Yeah.
From what is it now, about 15. And not only that, it's also big tax hikes on the wealthy. So you would certainly see, I think you would see a sell-off if Biden were to win. That said, there are clear tailwinds to Biden winning. One of them, being perhaps infrastructure stimulus, which Trump hasn't gotten around to doing. The other being perhaps smoother relations with China than we'd see under the Trump administration, and maybe just a more harmonious US in general. So there's sort of swings and roundabouts, but I think the hard data implications of a Biden presidency, the three big policies are the tax hikes on corporations and the wealthy, and the other one, as I hope, is a very big jump in the minimum wage. And so you can see how all of those things would shock the stock market in the short term. I don't think it would be permanent. In fact, I think actually all of them are very good policies for the economy and therefore earnings in the long run. And the stock market would bounce back, but I think it's definitely a candidate for a sell-off, yeah.
Yes.
Okay.
So, as I said, I think the next quarterly results are probably not going to be enough. They might be, but I guess the other thing is it could be six months, it could be 6 minutes. Like it's when the market sort of, I guess with the momentum driven trade, if you do get enough of a downturn, then all these tailwinds really turn into headwinds as the whole momentum turns in the opposite direction, and it's a quick get out as fast as you can. So.
Yes.
Very good. All right. So what are we most concerned about? And then we'll break for a couple of questions as well, fellas. The short list.
So look, there is a long list. Yeah, there's a long list, but I think that the key ones we're watching and worried about, is demand. So the amount of demand destruction that's occurred in terms of we're seeing consumers that have been growing debt faster than income for years, and we still had weak demand. Now we've got sort of these record losses of jobs and people locked at home and threats of future lockdowns and banks tightening lending criteria, all these other factors that are just saying that globally it looks like there's going to be this real demand shortage. And it throws out in the numbers. Even places like China, which has sort of been out of this longer than anyone, is still sort of operating largely at sort of 90% of capacity. And so there's this real demand destruction out there that's not looking like bouncing back anytime soon.
Yeah, absolutely. Huge output gaps everywhere, which means falling wages, no inflation, no pricing power for corporations, crushed margins, zombie companies. And that all falls under that heading of demand.
And layoffs that end up from that. I mean, I mean, we're still seeing plenty of layoffs from large companies. It's just sort of going through and going, okay, we were hoping we'd bounce back. We haven't bounced back. Okay, I need to shed another 5% of staff or whatever it is.
Yeah, and as you've noted now for a couple of months, Damo, there are structural changes in this demand shock. It's not just cyclical this time. It's the consumer is going to save more for the rainy day or the next pandemic.
Companies are going to do the same. They're going to save more for the rainy day as well.
Yes, companies will do the same, and you have the other changes like more working from home. And so you've got big commercial real estate problems. Excuse me. And then deglobalization, with the new and now titanic skepticism of China. All of these things are going to weigh on demand.
Yep. Then you get debt crises. So that we've got one big bucket there. The next big bucket is debt crises. So we've got consumer debt close to record highs. Well, in Australia certainly, less so else in some other countries, but it's still very, very high historically. Corporate debt in the US is at cyclical highs, and that's probably a little bit the opposite. In Australia is a little bit better on the corporate debt side, but a lot worse on the consumer side. And then you throw in those weak demand issues, and we've got all the signs that we're sort of ripe for a debt crisis. If you wanted to have a virus shock, you really was at the bottom of an economic cycle. So then you could use all this extra debt and all this extra people expanding to grow. We've had it happen at basically exactly the wrong part, where we're right at the end of the cycle already. We already had huge levels of debt, and so the odds of a debt crisis coming out of this is relatively high. We have suspended a lot of that for we've got all these central bank bailouts and government bans to stop people from being made bankrupt for short periods of time and things like that. As we reach the end of this period, and almost all of those programs were temporary, and then you start moving into companies actually going bankrupt. And that could easily spiral.
I mean, the sheer depth of the bailout is a direct reflection of all of that debt. Definitely.
Yeah, and then obviously it'll come as well once you start seeing some of those fall over, and you start saying, okay, well, say it's General Electric or someone like that in the US falling over, and you're saying now you're asking you're asking the governments, after they've just given trillions and trillions of dollars to all these companies, can we just have a few $100 billion more, and then the next company falls over, and so each time at that stage it's questions about where's the money being spent.
Absolutely.
What parts is this valuations? So you add all those bits in, and valuations in Australia have never been more expensive on a forward earnings basis. In the US, it's only been more expensive once, which was during the tech wreck. So as the GMO guys quite eloquently put, we're in the top 10% of stocks in terms of valuations, in terms of being expensive, and we're in the bottom 10% of economic outcomes. So there's this clear disconnect between what we're seeing on one side and the other.
Okay, very good. A couple of quick questions here, fellas, as well. How high do you think the AUD is going to go against the US? Well, that's a tough one.
Yeah, that is a tough one. I would simply say I don't think the AUD will turn until stocks do.
Right.
The correlation between the fantasyflation of equities and the Australian dollar has been unprecedented and remarkable, and I just think that the two are in lockstep for now. So they'll continue on until stocks fall. So if you can tell me when stocks fall, I can tell you when the AUD is going to turn.
Okay. Couple other ones. So what's your take on, so there's a couple of short options out there, BBOZ and BBUS, so OZ being a leverage short in the Aussie and the US being on the US. I'm not sure. Maybe it's a Damien question.
That sounds awfully like personal advice.
Yeah, look, I think we might have to... Yeah.
What I might say for that is, what I can say is, as general advice is, had a quick look at them. We haven't had an in-depth look at them because they're not something that fit into our mandate. But from the quick look that we've had them, we haven't seen any major problems with those as an instrument in order to get a short exposure.
Yep. Okay, very good. And just finally, one from me, just for the gold bugs out there, fellas. What's the take on what's been happening in the markets, and what do you feel about the gold side of things?
Well, we've got a pretty decent gold position, and I'm still bullish. Yeah, it's a bit strange because this whole fantasyflation idea, if it continues to play out on what is a typical cycle, then gold will be one of the next cabs off the rank, if you like, in terms of a rotation, because you'd expect to see the US dollar continue to fall. Mm-hmm. And so, gold would keep rising. I mean, it's got a good chart. Looks like it's kind of consolidating near its recent highs and is primed for a breakout. The risk, ironically, might be that the stocks run out of steam and we get a renewed correction. In which case we could see something of a rerun of what we saw during the risk parity shock earlier in the year, where you get back to some indiscriminate selling and gold gets hit again during another drawdown. But even if that were the case, I'd probably buy gold again during a period like that. Longer term, when you've got this kind of monetary debasement going on, then gold's pretty good as long as it's transpiring in the US. And so there's kind of two factors coming to bear on that. One is the extraordinary instability in the monetary underpinnings of the US. That's very bullish for gold. But at the same time, you still have America First policy going strong in Washington. That might change if you got a Democratic administration, but with Trump and his use of tariffs, and now post COVID-19 deglobalization from China, et cetera, that's very much more a strong dollar regime for the globe, if you like, and so those two tensions, or those two are in tension, going for the next cycle, if you like, once we get through, the more near-term considerations. But I still am bullish, basically. I mean, in terms of the second one being a headwind, if you see, a US-China Cold War really intensifying and that being part of a strong dollar story, it's probably also a strong gold story, just through the geopolitical risks that it brings. So I therefore tip over the side of gold bullishness, even in the longer term.
Right. Okay. Fantastic. Great answer there, Dave. And look, thanks very much, gentlemen, for a terrific show. And thanks to everybody for tuning in, and also for your questions along the way as well. Feel free to drop in any further ones, and we can reach out to you as required as well. So we hope you enjoyed today's episode. If you'd like to see more of our content, head over to nucleuswealth.com/content. To stay up to date with news from us, follow us on social media. We always appreciate guests or topic suggestions. So if you've got one, drop them in the comments of today's YouTube video and we can follow that one up. And finally, if you know anyone who would get something out of today's episode, let them know about it. So feel free to share it through and help our podcast series grow, of course. So on that note, I look forward to catching you with the next one. Cheers.